Hello, and welcome to the Dr. Money Matters podcast, the show where we discuss important financial topics that were never covered in med school. I'm your host, Dr. Tarang Patel. Okay, welcome back to another episode of the Dr. Money Matters podcast. This is an episode I've wanted to do for a while, as it's a topic that's interested me, and it's been in the news lately quite a bit. I practice radiology in Arizona, and many of the practices have had merged together last year and were purchased by or partnered with a private equity firm called Radiology Partners. The same thing has happened to the anesthesia group that works at the hospital that I practice at, and also recently the emergency medicine group was bought out by a private equity firm. I know many other places in the country are also experiencing this. In Texas, in Houston, a lot of the radiology practices have been partnered or purchased by private equity. In Florida, there's a huge influx activity with private equity and physician practices. And this has been happening a lot in radiology, emergency medicine, anesthesia, dermatology. In fact, today, actually, in the New York Times, there was an article about a journal article in a dermatology journal that there was pressure to be removed from the article from private equity because of some potential negative publicity or potentially invalid associations between private equity and patient care. It's definitely a topic that's on many people's minds. There's a huge lure to private equity because they can offer significant significant cash buyouts for people who are partners in a practice, and particularly if you're later in your career or are looking to exit out of medicine, up to multi-million-dollar payday is very attractive for a potential, 5-year or maybe even less commitment to practice. And then you don't necessarily have to deal with some of the uncertainties in medicine that are there in the long run. Obviously, there's some downsides. If you're younger or earlier in your career or plan to practice for a longer period of time, you may be sacrificing earnings. Private equity is not there to do anything but make money for their investors. That's one thing we should make no mistake about. That is their business. I'm not saying whether they're good for patient care or whether they're bad for patient care or whether they're good for physicians or whether they're bad for physicians. You'll have to make the analysis on your own. But my guest today, who's a radiologist with a practice in Dallas, Dr. Kurt Schoppe, he's very knowledgeable on the topic. He's a member of the American College of Radiology and part of their economic committee. And he's worked in private equity before. So we talk today about some of the terms that are used in private equity purchasing of medical practices, why physicians would want to sell, why private equity would want to buy practices. And, I just want the physicians out there to be aware of what's happening. The more knowledge you have, the greater bargaining power, the greater leverage you'll have when approaching these decisions. And ultimately, I'm pro-physician ownership, but we need to make the decisions for ourselves. So I encourage you to listen to this podcast episode. I really encourage you to share this episode with your friends and your physician colleagues, your residents, medical students. They need to know what's happening in medicine. And hopefully we can answer some of the questions you may have, and any additional questions you may have. Let's continue the discussion on the Dr. Money Matters Facebook group. But this is a really good episode. I think we answer a lot of good information and go into details about private equity and medicine. So I hope you listen. It's a long episode, so I'm going to split it into two parts. So make sure you listen to this episode and the next episode, and in their entirety, they're about 35 to 40 minutes each. But it's a really important topic. So please take a listen. Thanks again. All right. Welcome back to another episode of the Dr. Money Matters podcast. My guest today is Dr. Kurt Schoppe, a radiologist in the Dallas Metroplex area, who's on the podcast today to talk a little bit about the role of private equity in medicine. We've seen a lot of deals, especially in my field and Dr. Schoppe's field of radiology recently, where private equity groups have purchased practices, partnered with practices, developed practices, and then just starting to play a much bigger role in medicine in general. It's also been happening in the fields of emergency medicine, anesthesia, derm, ophtho. So, it's something that I think a lot of us have heard about, but not many of us are very familiar with it. Dr. Schoppe has a background in business, and he was an analyst at a private equity firm previously, and he's done a lot of work with the American College of Radiology in the medical economics and policy background. So I'll let him talk a little bit about that. But before we get started, I want to welcome Dr. Schoppe to the podcast.
Well, thanks. I appreciate you having me on.
It's one of those things that's been on a lot of people's minds recently, just because we start seeing these deals in the radiology websites, AmpMini, ACR. You kind of start seeing, private equity firms purchasing practices. Well, let's start with the beginning. What is private equity?
Sure. I think it's always good to take it back to the basics and look at it from the fundamentals. And so just looking at a private equity firm, let's take a very, very simple example. So a private equity firm is just a firm that's going to manage money, their goal being to make money for their investors. That's it. And so a private equity firm would raise a fund. So let's say they have a goal value of their fund for $100 million. Most of that money is going to come from institutional investors, large insurance companies, pension plans, the university endowments, things like that, or some very large private investors or individuals. And so they assemble that money, they make their $100 million fund. Usually those funds will have a goal in mind. Is it going to be a technology fund? Is it going to be a cash absolute return fund? Is it a risk mitigation fund? They usually have goals, but they're going to take that $100 million, and the goal is to use that $100 million to invest and make money. Sometimes there are what's called hurdle rates, whereas they don't get money until they make a certain amount of money for the investors. But they will be paid partially on just managing the money, but partially on the returns they make. And so that's all a private equity fund is. The private portion of it is these are individuals or groups that are not necessarily a public traded entity, though now some of the larger of the firms, there's at least one or two that have gone public.
It's one of those questions, though, that seems kind of nebulous to most people. Like we all know what companies in the New York Stock Exchange or NASDAQ are, and I think we hear these terms, private equity, venture capital. So I'm glad you clarified that, because I think that's something that a lot of people have a hard time grasping. So now we're talking a little bit about this as it relates to medicine. And like I said in the introduction, we're seeing a lot of deals in terms of these firms buying up or partnering with practices. Why do you think that is? I mean, traditionally, medical practice was, a group of physicians partnering together in usually in their own specialty, or they sometimes form multi-specialty groups, and then they would provide their services to a hospital or a health system. Why would private equity be interested in medical practices?
Sure, and there's a couple reasons. We'll take this and look at a big picture, and then get down to small details. And big picture, I'm a lumper, not a splitter. Big picture on this is that it's an opportunity to make money. So the question then is not why are they buying medical practices, but why is there an opportunity to make money in medical practices? And then you'll see this in the pitches for the groups. There's a lot of fragmentation in the market. So there's lots of small physician practices, even moderate sized physician practices, but that to them, when you compare it on the scale of a national economy, this is a very, very fragmented market. And so it provides an opportunity. One of those opportunities is leveraging size. So in a metropolitan area, if you have a bunch of small medical practices, those medical practices do not have a lot of leverage with hospitals or payers to either affect their reimbursements or affect how their contracts are written. If you consolidate a lot of those practices, all of a sudden, instead of having a bunch of practices who are 5% market share, if you consolidate a lot of them and you're 40% market share, then you're an entity that cannot be ignored when you start negotiating with payers or hospitals, because they can't afford not to have you in their network or not to have your physicians. So that fragmentation is part of it. Another part of it is a lot of physicians tend to do what they're good at, which is practice medicine. Not a lot of physicians pay attention to compliance, regulatory issues, reimbursement issues. And so practices, by and large, tend to be run relatively inefficiently. And so one of the things that these private equity groups are good at is operations, logistics, and processes. And so they're going to squeeze as many nickels as they can out of just the normal processes and other things that physicians tend to ignore or they don't spend a lot of energy on. And so when you take that from a lot of small groups to a smaller number of bigger groups, there's efficiencies in scale there, especially when you make those processes more in line with a normal business enterprise. And so you go from fragmented market, consolidating the market for your leverage. You take inefficient business practices, whether it's regulations, payment policy, et cetera, on the practice level, and consolidate that into a bigger group. You'll realize efficiencies of scale. Things will cost less per unit. And you can extract returns from those groups that way. And at the same time, you have opportunities for investments that could improve the efficiency of the practice or the returns on the practice, while a group of 10 physicians, if you wanted to buy $100,000 worth of software, that's $10,000 per physician. If you have 100 physicians, that becomes $1,000 per physician. And so you have an ability to spread investments over a larger number of revenue generating individuals. And these are all reasons that there's an opportunity in healthcare for these firms and see it. The other thing, if we look at it on a macro level, if you look at returns in the stock market by section of the economy, healthcare has had very, very large returns in the last 10 to 15 years relative to other sectors of the economy. People pay attention to tech, but there's a lot of winners. You pay attention to the winners in tech. You don't pay attention to a lot of the losers. There hasn't been a lot of losers in healthcare. So as a sector for investment, it looks very good. Now, one could make the argument that this is now late money chasing after gains, but that's just tends to be what people do. That's humans. And so that also gets down to the reason why PE firms or large corporate entities, we tend to look at this only as a private equity thing because they've made splashy deals and consolidated others, but there's corporations that do this too. Mednax, Envision Healthcare, previously AmSurg and Sheridan and others that have since been consolidated. So these corporate and private equity entities look at the fragmented market and look at the inefficiencies of the physician practices, and they see an opportunity for gains because they can improve their negotiating ability, they can improve their revenues, and then in exchange for that, they're going to be able to extract cash flows from that group.
Okay, so it seems like, I feel like these are kind of the classic pitch that has happened in previous generations too in healthcare, where now it's corporations or private equity buying it. Before it was hospitals and health systems buying practices. So are they really able to deliver these kind of promises? I mean, are we too early to decide that yet, or?
Not necessarily, but there you go, asking logical questions. You be careful. You gotta just frustrate yourself doing things like that. I think there's two different things we're looking at, and this is one of those habits I think we have as physicians. Is you look at all outsiders the same, And that's not the case. The reason that hospitals were buying physician practices was different than the reason private equity firms are buying practices. One of the reasons that hospitals have been going after practices is because of the way that healthcare is reimbursed. And this comes back to a lot of the work that I do with the American College of Radiology in working on government payment policy and private payment policy and healthcare economics. So a reason a hospital would want a physician group, there's a few. Principally, one, it tends to bring physicians under the hospital control, and it affects their referral patterns where they're going to tend to refer that business to the hospital. They can't explicitly require them to do this, but there's a lot of direct and more indirect ways that they can ensure that referral pattern, because to do it directly or to write it into a contract would be illegal. Right. But they can bring a lot of pressure to bear or incentivize you to refer or keep those referrals internal, not just referrals for hospital level services, but referrals within the other physician specialty groups that the hospital may own. They can also make it very much easier for you by having an integrated health record. And they're not doing that for their own benefit or necessarily the benefit of the patients. That may be a reason, but what really comes down to is how the healthcare is reimbursed. And physicians for Medicare patients get paid on what's called a Medicare physician fee schedule. That's the RVU schedule for the procedures and evaluation and management services that we bill. Hospitals, that's a professional fee schedule. Hospitals are billed on a technical fee schedule called HOPS, the Hospital Outpatient Prospective Payment Schedule. When physician groups are owned by the hospital and undergo what some people call like a provider conversion, they no longer bill under that Medicare physician fee schedule. They get to bill under the much higher hospital fee schedule. And so the technical reimbursements for the same service performed in a physician office versus performed in a hospital outpatient office are vastly different, where the hospital payment rates can be 2, 3, 4x higher than the physician office based. And that's why you had a lot of those office-based provider conversions. So the hospitals are bringing the physician practices under the hospital umbrella and billing under that TIN or the tax ID number of that charter because they could get reimbursed at much higher rates.
Right. And I think we've seen a lot. I'm sorry, I was going to say we've seen a lot of fallout and negative publicity regarding that in the last few years because, patients were saying, I used to go to my physician and I'd get a chest x-ray or EKG in his office when he or she was an independent physician and it was this price. And then the next year they sold to the hospital and now I'm paying 4X or my insurance is paying 4X. So, and
your co-pays are different when you get treated in those different settings, and the rules are different when you get treated in those different settings. And nothing actually may have physically changed in the doctor's office. And for us, for our specialty in particular, for radiology, this is one of those reasons that radiologists tend not to own imaging centers anymore. Or if they do, they're joint ventured with the hospitals, because the hospitals, when they own or manage the physicians, they will divert referrals around those imaging centers, even though it's cheaper for patients to get imaged there because they don't see the revenues and they're not the hospital's imaging center, so they can't bill under those hospital rates, which is why a lot of the hospitals have opened their own imaging centers, but they open them up and define them as hospital outpatient departments. That's HOPD. And so they get to bill the hospital rates. So that's one of the reasons hospitals took over physician practices. It's a different reason that private equity or corporate owners would take over physician practices, but there's still the same fundamental underlying concept of make more money.
So let's get back to that. So that was a very good explanation. I think you defined and clarified the two kind of entities there, why hospitals would have wanted practices and what maybe why private equity wants practices. So going back to, private equity or these corporate purchases, let's talk about it on the flip side. We see why they want to buy. Why would a group want to sell to one of these entities?
And this is something we have a fair amount of experience with. My group has made the decision not to participate in those sales, but we have sat down with several PE firms, even some of the corporate firms, and gone through their pitch because we want to understand what they're selling. And make no mistake, one of the things these people are very good at, just like Wall Street in general is very good at, is selling an idea. And it may not necessarily be in your best interest. That's our opinion. But it's because we believe in the private practice of medicine. We think it's better for the patients and it tends to be more efficient than these than a different way of managing the healthcare practices. Plus, people tend to discount that we've done this game before, not just in hospitals buying physician practices, but 80s, the HMOs. There was a lot of physician consolidation and corporate management of medicine. People forget Health South doing it in the rehab and ambulatory surgery center space and then failing spectacularly. What's old is new again. If you take the timeline long enough, we've done these cycles and we're back in doing one of these consolidation cycles. And our opinion is it's going to end poorly. But there are reasons that people look at potentially selling their practices. There's, in general, we'll go from least important to most important. They see a lot of these deals done and there's a fear of missing out. They see money to be made. They feel like other people are doing it. It legitimizes the practice. So we should sell our practice while the getting's good. It's probably the least important, but it matters. And when we've talked to some of the smaller groups in the area, of which we've merged with a few, that comes up. And it is a little disappointing. It's not a logical way to evaluate it, but it's there. The fear of missing out. The other is the fear of some of these regulatory requirements. When you have the quality payment program from Medicare and dealing with these administrative hassles, when you're a smaller physician practice, even getting up to 30, 40 members, participating in some of these programs can be administratively and logistically difficult and inefficient at a certain level. And at some level, you may not have the expertise to optimize your participation. And that expertise tends to exist in larger practices, healthcare systems, or the private equity groups or corporates are willing to sell you their expertise, but it's very expensive. So that fear of regulation and the unknown and how to deal with it. But then it also comes down to understanding that Medicare and a lot of these other payers want to change the way they pay for healthcare. How do we participate, or how do we transition from a fee-for-service world into one of these bundled payments, alternative payment models, these other risk-based reimbursements? A lot of the specialties, if you look at the ones that have been consolidated, they don't necessarily play well in these alternative payment models. Radiology, pathology, ophthalmology to a certain extent, anesthesiology. These are all these fee-based services that don't necessarily have the ability to move a lot of dollars around like primary care or some surgical specialties can. But what they do bill is a lot of units of a lot of fee-for-service work. But then let's get back to why would a group want to sell? At a certain point, it still comes back to money. And so if you're a physician practice that has a dominant market presence in your city, doesn't have to be a big city, but you're dominant in the city and you're dominant with the payers, there's a lot of value in that to be extracted, especially if there's some efficiencies there. And so you may get paid on a multiple of your earnings. If you're within 4 to 5 years of practice, at a certain point, it just becomes logical. You're not looking for 20 years down the road. You built up the practice. You're the senior partners. You're looking towards retirement. It's easy to take a payout, ride out your contract for the 3 or 5 year term that most of those corporates or private equities would demand that you stay on after the sale. And then you're set. It's the people who bear the brunt of this, the sales process. If there's a negative to it, it's the people that are going to have 15, 20, 25 years to practice. And then one of the things that gets asked is if this is such a bad model, well, then, when these senior partners, these people that build the practice leave in 3 or 5 years, if they don't like it, well, how are you going to get people to come into it? And my answer is those new people are critical to the success of the model because they cost a lot less than the senior partners. Somebody coming out of training who's used to only making $40,000, $50,000, $60,000 as a resident has a bunch of debt. Well, their salary as a private practice physician or attending physician looks really, really good compared to what they have now. But what they don't realize is that the steep discount they have compared to the partners that were out 5 years ago. And that gain, that delta there between what the old partner made and what a new hire would make is entirely going towards the corporation or the private equity firm. They're not going to be sharing that with you.
Right. And there's no upside in, when you're in normal practice, you start out as a junior partner, you work your way up to senior partner. And generally as a profession, physicians don't tend to discuss this very openly, and good or bad. I mean, open discussion of salary with other non-physicians is not always a good idea. But in general, the lack of transparency kind of hurts us on an individual setting because when you, like you said, when you're coming out, you don't really know unless you come from a medical background or have really been following these kind of things. You don't really know what the upside is. And you're absolutely right. When you've been making 50,000, all of a sudden 200,000, 250 looks really good, but not knowing that, there was a much higher upside in the long run. So,
yeah. And you're going to be working just as hard as that person who is getting paid more, but now you get just paid less, but you don't necessarily have the context or experience to know that. But that's what we call arbitrage right there. That's information arbitrage. So they're arbitraging the fact that they know what you could have made and they're getting that value of work out of you. It's not like the physicians weren't creating that money that was paying higher salaries, but now you're still creating that money. It's just somebody's taking advantage of the information asymmetry and they're taking the gains instead of sharing them with you.
And that's what with podcasts like mine and just with social media and stuff, I want physicians to understand the value of the services they provide. What they end up doing with that information is entirely up to them. But it's just important that kind of information kind of gets out there. So now let's go back to one other thing. I mean, you've touched on it a little bit, with the information asymmetry, with the efficiencies and things like that. But one of the big things, and you kind of addressed this also, was private equity firms obviously are not doing this out of the goodness, or corporations, whatever, are not doing this out of the goodness of their heart. They're there to make money. What kind of returns are they looking for? Are these big percentage returns? Is this because it's a steady deal flow? Are they looking for 5% a year? Those kind of things. What are they hoping to gain from the practice?
Right, and that's a very good question, and it's important to look at their expectations, and so you mentioned 5%. Well, if you look, the best comparison is you start from a risk-free return. So what would Treasury notes, bills, bonds pay? And you're looking somewhere in the 1% to 3% range across a range of maturities and bills. That's considered a risk-free return. And you're looking at an inflation rate of in the low 2s. And so the real return on those is only going to be about 1. Most of these are going to look for much higher than that. But you're not necessarily looking at venture capital money because that's a boom bust type return. You're looking for 100, 200 times return on a single investment, knowing that 8 or 9 of your other investments are going to return nothing. So now we're going to collapse towards the middle, where a lot of these are not necessarily looking for your unicorn type return deals like an Uber or a Twitter or Facebook. They're looking at these businesses because they cash flow well. And it can be considered a relatively low risk business that produces a lot of cash, almost on the level of like a utility. And that gives you a little insight into how they consider the doctors as essentially cogs in a wheel that generate money, and that they're going to siphon off some of that for their need. And I'm framing this negatively for a reason, but yes, they're not looking at this to necessarily advance patient care, though that's probably in their marketing materials.
Of course.
Physicians may be advertised as owners of one of these entities, but you have to look at how they structure these pools. And this is one of those things, having a little bit more of a business background. The shares of Facebook that Mark Zuckerberg owns are not the shares of Facebook that you or I could buy on the market, nor the shares that the physicians own in one of these entities the same as the controlling shares that the sponsoring private equity firm or corporation are going to own. So you might have a de facto ownership, but it's really just to be able to put you on marketing materials. So the private equity firms or corporations are looking for a relatively low risk business that produces reliable cash flows. Those reliable cash flows are worth something, especially when they're fairly dependable. And that gets you into what's their goal. Most of these firms are going to buy, consolidate physician practices, try to realize some of the efficiencies that I mentioned earlier through market fragmentation, improve billing processes, and answer some of the other technology investments that they may need, basically to improve their efficiencies, to improve their cash flow. And then based on those cash flows and the change in those cash flows, they're going to put this out for bid for a larger fish. So then this is and when you're looking at a private equity deal, you look at their entry point, buying these groups, and you have to look at the exit point. And the exit point most frequently is going to be a sale. And this sale may be to another bigger private equity firm as they consolidate some of these physician practices. It may be to a corporation, it may be to a hospital system. But they'll take a firm that they spent $10 million to buy through other efficiencies, and they're going to realize cash flows on it, and they're looking to sell it at a multiple. And that multiple could get them 50%, 100%, 200% return, depending on how they've consolidated and the changes they've made. And so that's the return they're looking at. They look at reliable cash flows. Those cash flows can be used for, other lines of credit, debt, to buy other physician groups. Then they bundle them all together, supposedly show outside gain and change the way that you practice medicine, and then sell it to somebody else at a multiple.
Okay, that's a very good explanation, and I almost, in a way, you could liken it to someone who, in a real estate investment scenario where they might purchase, a single family home or like 3 or 4 single family homes together, because these are inefficient, independent things. Update the management, update the infrastructure a little bit, and then package the entire group of 4 or 5 homes together as a deal, and you get a premium on that. At least that would be the goal. So it's
very similar for these deals, but you also have to remember they usually enter these with a timeline. A lot of these funds have a timeline. That timeline could be short, 3 years. Most of the ones that we're talking about that were part of the healthcare fund, these private equity firms have what's called, redistribution requirements, or a capital event, where their investors are looking for the beginning of some of their return, because these investors are locking up money in these returns for a certain number of years where they can't get it out. They expect better than market returns. Whereas you or I, if we invest in like a S&P 500 stock index fund, that fund we can trade anytime the markets are open, every day the markets are open. These investors, when they give money to a private equity firm, know that this money is locked up for 5, 7, 10 years. So they, because of that illiquidity, as in they can't get their money in and out easy, they expect higher than market returns, but they still expect returns. The private equity firm just can't hold this money forever. And so these funds tend to be on a timeline. And what's really going to be interesting is the next year to 3 years, a lot of these funds have to realize capital returns for their investors. So you're going to start to see, if you think the environment's been busy now with them buying practices, wait until they have to start selling them. And they want to be selling them in a market like right now on the upswing. If the macroeconomic environment changes, it could get messy.
This is a very good point. And it kind of ties in with what I'm going to talk about a little bit next is, there was an article recently, Jim Chanos, a pretty famous investor, mentioned one of the companies that that's actually publicly traded, and talked about this whole business of buying up medical practices and efficiency and what we've just all discussed. And he's quite negative on that. He basically is shorting the stock of one of these companies and saying that there's really no value added to what they're doing. So what you're talking about, it is going to be an interesting thing, because what we're happening in this is an incredibly long bull market that we're in. Everything seems to be, knock on wood, going really well. But as we all know, that doesn't last. So it's going to be interesting.
And I use the COG in industrial manufacturing comparison for the physicians for a reason. And it's not to denigrate the physicians, but a physician is not a software product. A software product like Twitter or Facebook or some of these other companies, if you sell that software to 10 people, you can probably support that software with 1 or 2 employees. If you sell it to 20 people, you probably can still support it with 1 or 2 employees. You sell it to 100 people, maybe you need 3 or 4 employees. Physicians and the revenue or money that physicians generate doesn't scale that way. If you have 10 physicians, they can only do so much work in a day. If you have 20 physicians, you don't get twice, you get exactly twice the work. There's no multiple to achieve there. And so a lot of these promised returns don't necessarily scale well. But what does get harder when you add physicians and others is administrative complexity. And so instead of your costs always going down, a lot of times your costs are scaling directly as you add physicians, and sometimes disproportionately because you have other risks as you get larger that you don't have in a small, more efficient firm. And then that's the other thing that people aren't considering. Big things are hard to manage. And with a dynamic environment like healthcare, one of the reasons that healthcare is stagnated and other large entities have problems is they don't change directions very well, and they're not very efficient. And so if you put and bundle a lot of these physician practices all together, you're creating something that can be very hard to manage. And if they change the way that things get reimbursed, or you have changes in RVUs for codes, and so you generate less revenue, you can't switch gears very well as a very large firm, whereas a smaller group of physicians is a little more nimble and can change the way they operate or function in an environment much more so than a large firm that steers more like a cruise ship as opposed to a little speedboat.
Okay, that was the end of part 1 of this episode. I hope you found the conversation interesting and learned something new about the world of private equity and medical practices. Listen to the next episode to get the rest of the story with Dr. Schoppe. I encourage you to continue the discussion on the Dr. Money Matters Facebook group. Thanks for joining us on another episode of Dr. Money Matters. If this is the first episode you have heard, I appreciate you taking the time out and listening, and encourage you to listen to our past episodes. I would also appreciate you leaving me a positive review on Apple Podcasts, and also recommend you join our Facebook group where we have ongoing discussions about this and other topics in order to help each other reach our financial goals. Finally, I encourage you to subscribe to our email list and also to subscribe to the podcast itself on the various podcast app that you use in order to be kept aware when the latest episode comes out. More episodes of this podcast are available at www.drmoneymatters.com and on Apple Podcasts, Google Play, Stitcher, Spotify, or wherever you listen to your podcasts. Audio versions are also available on YouTube and Facebook. And you can follow me on Twitter at drmoneymatters or on Facebook or Instagram at Dr. Money Matters, all spelled out. Thanks for listening, and if you get a chance, please leave a positive review for this podcast as it helps move the podcast up the rankings on iTunes and gets it exposed to a wider audience. Thanks for listening once again, and stay tuned for another episode coming soon.